So if you have money in your bank account and you pass away, yes, that money goes to your kids or your beneficiaries, whoever you're leaving it to, but it's not as efficient as it could be. And what I mean by that is with a private contract, you have a death benefit attached to it, and that death benefit is paid out income tax free, and it avoids probate court. And that's a huge, huge thing. Not sure if you've ever gone through that yourself or you know someone who's gone through it, but it's not a fun process at all. And then the tax piece, the money in the bank account is going to be taxed to your heirs. So that's a huge, huge component, because who knows where tax rates are going to be in the future. They could be higher, they could be lower, but it's a gamble either way. We don't know. None of us have a crystal ball on what the tax rates are going to be, and we also don't know when we're going to pass away. But with the private contract, you at least know, hey, this benefit, I know what benefit's going to be paid out at a certain age. Obviously, we don't know when we're going to pass away, but you know that whatever that benefit is, your family, your church, whoever you're leaving the money to, most likely the bulk of it to your family, they're going to get all of it. And there's not going to be any income tax on it. Now, I have to put an asterisk here. There might be estate taxes on it, depending on your situation. That's a whole, I'm not going to get into that for this video. It's a whole different discussion. But it's just a very tax efficient and seamless way to transfer wealth without all these other hoops and hurdles that you have to put your family through so that they can get those funds. And the other thing I'll say about the legacy piece is, obviously with a bank account, whatever money you've built up in there, that's all the money that's going to be passed down to your kids, your heirs, whoever you're leaving it to, minus the taxes, and there's no death benefit. With these private contracts, the way it works is you build up a cash value over time, savings if you want to look at it like that, and you also have a death benefit. Now, when you pass away, and this is a very, very important thing to know, when you pass away, the cash value blossoms into the death benefit. Okay, so there's not two different piles of money, if you will, that are paid to your family or whoever you're leaving the money to. So if you had, for example, $500,000 built up in your cash value and you had $1 million death benefit, your family doesn't get a $500,000 check representing the cash value and then another $1 million check representing the death benefit. The $500,000 is going to be baked in or blossom into that $1 million death benefit. And I can break down, this is a whole nother video in itself, but the easiest way to explain it to you guys is, think of a home. So you bought a home for $500,000. And let's say when you went to sell it, the fair market or the value of it was $1 million. And we're assuming you have no debt on it, okay? So you bought it for $500,000. You sold it for $1 million. How much money do you get in that sale? Do you get the $1 million that you sold it for, or do you get the $500,000 plus the $1 million, the equity that you had in that property? No, you don't get the equity and the price that you sold the home for. It doesn't make any sense at all. It basically the equity blossomed into the sale price of the home. And that's the easiest way I can explain how it works for a private contract. You don't get both the equity, which is your cash value in your policy, and the death benefit separately. It's combined together, if that makes sense. And that's the easiest way I can explain that.